As the U.S. markets are closed for the weekend, Netflix Inc. finished Friday's trading session, October 3rd, 2025, at $1,153.32, a decline of $9.21, or about 0.79% for the day. Now, a slight pullback like that on a Friday is hardly unusual, especially for a high beta name in the tech sector. But the figure itself hides a far more interesting story that's unfolding just beneath the surface. While most of the market's attention is fixated on subscriber numbers and the next blockbuster release, the real drama for Netflix is happening in the options market and within institutional filings, where a quiet but significant repositioning suggests that the so-called smart capital is bracing for a level of volatility that the common shareholder might not see coming. The expectation is that Netflix has matured, that its path is one of steady, predictable growth fueled by its ad tier and gaming initiatives. The reality is that the company is entering one of its most turbulent phases, where the very foundation of its business model is being tested from all sides. The prevailing belief among many retail investors, perhaps those making trades on platforms like Robinhood or using SoFi Invest, is that Netflix has already won the streaming wars. They see a content behemoth, an essential utility in the modern household, as indispensable as electricity or internet service. This narrative suggests that with the password-sharing crackdown successfully converted into new subscriptions and the ad-supported tier attracting a new demographic, the company's future is a straightforward climb. This view is reinforced every time a new show becomes a cultural phenomenon. But this is a dangerously simplistic take. The deeper reality, the one being debated inside the walls of Fidelity Wealth Management and among clients of Interactive Brokers, is that Netflix is no longer a disruptive grower, but a maturing incumbent in a brutally competitive field. Its victory was not final. It was merely the end of the first chapter. Now it faces the attritional warfare of a saturated market, where every new subscriber is fought for and pricing power is constantly under threat from Disney, Amazon, Warner Bros. Discovery, and an ever-expanding list of competitors. This isn't a victory lap, it's a multi-front battle for retention and relevance. Looking at the recent stock movement gives this tension some color. Friday's trading volume of 3.13 million shares was right around its 3-month average, suggesting a day of consolidation rather than capitulation. However, the intraday chart showed a struggle. The stock opened near $1,165, attempted a brief rally but was quickly sold off, finding a low near $1,143 before clawing back some of those losses into the close. This pattern of failed rallies has been a recurring theme over the last month, a period in which the stock has shed over 4%. Technical analysts are pointing to a key support level around the $1,150 mark. A sustained break below this could open the door to a further downturn, while the resistance sits firmly around $1,250. What's more telling is the negative volume balance, where trading volume is consistently higher on down days than on up days. This indicates a subtle but persistent selling pressure. While some investors are busy comparing the growth of Netflix to that of Tesla stock or Apple stock, the underlying technicals for Netflix are telling a story of weakening conviction among buyers. This isn't just retail sentiment. Recent institutional holdings data from the end of the last quarter showed a significant divergence in strategy. While major index trackers like Vanguard and BlackRock slightly increased their positions, as expected, more active managers showed signs of trimming. Capital World Investors and Price T. Rowe Associates, for instance, both reduced their stakes. Even more striking is the insider activity. Over the last 6 months, there have been hundreds of sales by company executives and 0 open market purchases. While these sales are often part of pre-arranged trading plans, the absence of any insider buying at these price levels is a detail that shouldn't be overlooked. This contrasts sharply with periods in the company's past when executives bought shares during dips, signaling their confidence. For those using tools like Schwab Intelligence intelligent portfolios for a more automated approach to investing, these are the kinds of underlying trends that algorithms weigh heavily. The flow of institutional capital is a powerful current, and right now it appears to be churning with uncertainty. Of course, to understand where Netflix is going, we need to be clear about what it is today. Netflix is a global streaming entertainment service offering a wide variety of TV series, documentaries, feature films, and mobile games across numerous genres and languages. It operates on a subscription-based model, with different pricing tiers offering varying levels of access and features, including the crucial and still relatively new ad-supported plan. This business model was once a revelation, freeing consumers from the rigid schedules and commercial-heavy experience of linear television. The company's success was built on a massive investment in original content, data-driven decision-making, and a user-friendly platform that became the industry standard. Past performance was astonishing, with the stock delivering incredible returns for early investors who practiced self-investing and had the foresight to see the shift in media consumption. However, the very success of this model invited a flood of competition, including some of the largest and best capitalized companies in the world, each now vying for the same pool of consumer discretionary spending. This brings us to the future outlook, which is where the gap between expectation and reality becomes a chasm. The optimistic scenario, the one priced into the stock's fairly high valuation, is that Netflix leverages its scale and brand recognition to continue its global expansion. Growth in regions like Asia-Pacific and Latin America are expected to offset saturation in North America and Europe. The ad-supported tier is projected to become a multi-billion-dollar business, and the foray into live events like sports and comedy specials is seen as a way to create unmissable cultural moments that drive signups. Furthermore, its nascent gaming division could evolve into a significant revenue stream, creating a more comprehensive entertainment ecosystem. In this version of the future, Netflix becomes less of a pure-play streaming service and more of a diversified media giant, justifying a valuation more in line with a company like Nvidia stock, which dominates its respective field. Online investment sites are filled with bullish cases based on these potential catalysts. However, the more cautious reality check presents a series of formidable risks. The cost of producing hit content continues to spiral upward, creating an arms race that puts immense pressure on margins. An $18 billion content budget for 2025 is a staggering figure, and it requires constant success to justify. A few high-profile flops can have a material impact on financial performance and subscriber sentiment. Competition is not just intense, it's also strategic. Competitors are bundling services, Disney Plus with Hulu, Amazon Prime Video with its e-commerce empire, creating value propositions that are difficult for Netflix to counter on its own. There's also the macroeconomic pressure. In an environment where consumers are watching their budgets, the monthly subscription fee for streaming services is an easy place to cut back. While streaming has proven more resilient than, say, dining out, it is not immune to economic downturns. This is the scenario where subscriber growth stagnates, average revenue per user flatlines, and the stock's valuation comes under severe pressure. Now, for a moment, I want you to think about the content. Comment below with the single most expensive show you think Netflix has ever produced. In the end, the story of Netflix is no longer a simple narrative of a disruptor changing the world. It's the far more complex tale of a newly crowned king defending its throne. The expectation is one of continued effortless reign. The reality is that the kingdom is under siege. While the company has proven itself to be remarkably adaptable, successfully navigating the transition to streaming and more recently the introduction of advertising, the challenges ahead are more significant than any it has faced before. The path forward is not a gentle upslope, but a treacherous climb. Investors managing their own individual brokerage accounts must look beyond the headlines of hit shows and subscriber counts. They need to analyze the churn numbers, the cost of subscriber acquisition, the average revenue per user in emerging markets, and the competitive landscape. The disconnect between the casual user's perception of Netflix and the underlying financial and strategic realities is where both risk and opportunity reside. The company that redefined entertainment is now in the process of being redefined itself, and the final script is far from written. Don't forget to subscribe to US Stocka for more in-depth market insights, stock updates, and analysis on the companies shaping tomorrow's markets. Stay ahead, stay informed.